we're going to talk about revenue-related fraud, and in a future video, we're going to talk about inventory fraud. So that's chapter 12, revenue and inventory fraud. So these are two of the biggest frauds, and certainly revenue fraud is the biggest. Why would management create revenue frauds? Well, the main reason it's the most popular is because net income is what drives investor decisions and bank decisions very typically. They're looking at earnings per share, therefore net income. And how can you mess with net income? Well, you can either mess with revenues or expenses. It's a little easier to mess with revenues than it is expenses, because with expenses there's some third party that's wanting to be paid. Now, can you mess with them? Sure, you could call an expense an asset, capitalize it. So you can certainly mess with expenses, but revenues are a little easier to mess with and not get caught. Typically they'll either record fictitious revenues, so they'll just make up a sale, and they'll put it on there with also a made-up account receivable, right? Because revenue doesn't have anything to do with cash, not in accrual-based accounting. They can say, oh, we had a sale, and make up a fake document or something, and then make up a fake receivable. Now, obviously, the drawback is nobody's ever going to pay that receivable, right? So keep that in mind. Or they can just record revenues prematurely, right? So many revenues, especially these very extremely large organizations, are contract-based. They've got these long-term agreements with people, and the issue with revenue is, when do you recognize it? Well, we all know you recognize revenue when the service is rendered or the product is delivered. But there can be some fine lines to where it got delivered, especially on these longer-term contracts. So recording it prematurely, putting it in this quarter when really it belongs in next quarter. We didn't deliver it, we didn't provide the service, but we're going to recognize it now. The reason they do it so much is it's kind of easy to do, and it's easier to kind of hide, because there's different ways of recognizing revenue. So I think it's nice that we stop here for a minute and talk about revenue recognition. Just a reminder that revenue recognition has an event that triggers. When does it go on the books? Well, it goes on the books when the product is delivered or the service is provided, right? So you've earned it, right? So if you're recognizing revenue, it means you've earned it. You've done what you were supposed to do. But GAAP also says, well, that revenue not only has to be earned, but it has to be realizable. In other words, you got to be paid for it someday. And you don't have to be paid for it in cash when you do the service, but it has to be provided. That revenue has to be earned from somebody who's going to actually pay you for it someday. So you can't just provide service and say, I know you're bankrupt or whatever, so take your time. It has to be somebody who's really going to pay you, and that good that's delivered has to be not likely to be returned. There's some schemes that involve channel stuffing and things like that we'll talk about, that you're going to get that product returned to you. So if you know that it's going to get returned, it's not really a sale. Things like, if you know you're not going to get paid, if you know the product's going to be returned, you can't call it a sale. Okay? So these little distinctions between when something is and isn't a sale or service revenue gives people opportunity to commit fraud. So the easiest way to commit fraud is to just create some revenue and make some receivables, right? That's some very famous frauds of Health South comes to mind. They just created a bunch of fake revenues and went ahead and made receivables, right? And the thing about hospital type revenues is they're coming from Medicare, Medicaid, insurance companies, third parties, and those take a long time to get in. So it's oh yeah, it makes sense that receivables kind of late, right? So they just make it up. Sometimes what they do is premature recognition. So in other words, they won't just flat make it up, but they say, well, we know that this revenue is going to happen. We've got this contract, or we've promised to deliver this good or service, so we know it's to a legit customer, but that's really not till next period. But you know what? We're not going to make our numbers this period, so let's just claim it this period because we know we're going to get it. All right, so you can do things like say you've done more work on a contract than you really have, right? You can, it's easy to imagine something like you're building a jet. It takes months and months, right? You're building a building, right? So you can say you've done more than you have. And who's to kind of say what percentage of completion has occurred? So they just, create fictitious documents, just do all kinds of forging of contracts, topside journal entries. So you get to the end of the month, and you go, oh, we're not going to make our numbers. We need some additional revenues. So instead of going through the accounts receivable and the customer account level, right? Instead of going to the subledgers, you just go to the top side and you just post transactions to the sales and the accounts receivable control accounts. So that, of course, would be a pretty obvious sign that something's going wrong. But it's easy to do. So you just go in and do an accounting transaction, right? Just debit and credit, and you've got a sale on the books. So for us to best understand how to recognize revenue fraud, because that's what we're doing as fraud examiners, we want to find the revenue frauds. We need to understand how revenue works, right? So by understanding how our clients that we're auditing recognize their revenue, then we can understand, okay, well, what accounts are affected and what would it look like if they were committing fraud. All right? So on a basic revenue transaction, this flowchart kind of shows what happens. First, you sell some kind of good or service, right? So this is a real life revenue trend, not a fake one. But you can see, okay, well, step one, what could I do? Oh, I could fake selling a good. I'll have sales revenue and I'll have an account receivable. In real life, I have to estimate how much of my sales are not going to be collected, right? So I have to take bad debt expense, set up an allowance for when things don't get paid, right? So that's one place. Another place, oh, I could take too small of bad debt expense. I could say fewer people are not going to pay, right? So there's another issue. So next, sometimes goods get returned. So here's another nice place where we can do some fraud. Just not say something got returned, right? If we're channel stuffing, we could just say, okay, we didn't get anything returned. So there should be a returns account. We should be getting paid for the receivables. That's part of the system, right? We should be getting paid. If we don't get paid, we should be writing it off. So again, here's a little entryway. If I'm doing a fake sale and a fake receivable, or I've done a sale to somebody who I know won't pay me just because I want that sales revenue high, I won't get paid. Well, writing it off is how I would take care of that. However, maybe I don't want to write it off. Accounts receivable are an asset, so here's another opportunity to mess with the numbers. Discounts. Sometimes when we make a sale, we offer a discount to our customers. A discount for paying cash, discount for paying early, discount for large purchase amounts. So here's another issue, right? Sales discounts can't be part of my revenue, right? I have to take that out of there because it's really not part of my sale. So suppose I just don't put down that I took that discount out, right? So collecting the cash. So if I don't collect the cash, I have to go back and write it off. So I could say I collected a different amount of cash than I did. So understanding how a sale works is important. So you can then go on ahead and understand, how your client, so knowing how your client does things in real life, that's a general idea of how revenue everywhere kind of works. Now, does your client have some specific steps in between, like credit approvals, sales discount approvals? Sure, they probably do. So you could look at that stuff. But you can match this diagram to this chart that's in your book if you want to look at it a little more, and understand how they can use different parts of the sales process, sales and collection process, to commit a fraud, right? So for example, when you sell it, you can record fictitious sales, right? There'll be some, how can you do that? Well, just related party, sham sales, bill and hold, side agreements, consignment, round tripping. There's a lot of little schemes they use that I'll describe in a minute to just kind of put a fake sale or a fictitious amount, maybe more than it was on the books. Of course, you can recognize revenues too early. Yes, you've got this contract. No, we haven't completed the work this month, but we're going to say we did this month, right? So we can overstate real sales. In other words, not take the discount out, something like that. Of course, on estimating uncollectibles, we can just understate that allowance and overstate our receivables. On returns, we just pretend like something didn't get returned, right? Because if it gets returned, it's not a sale. Or if it does get returned, we just wait till the next period, right? So that way, because what we're trying to do is inflate this period maybe and worry about next period, right? So just, yeah, they returned it today, but we're not going to count it as a return till the end, after the end of the month, right? And so on, as you can read in your book. Don't write off your accounts receivable. Make some kind of adjustment to refresh it so it doesn't look 90 days late, right? So you can lap by applying one customer's cash to one of your fake customers' cash, and then when another person comes in, you apply it to that, right? So you're kind of always playing catch up with the cash postings. And just make up a posting. Don't record discounts. So all these different types of schemes are going to come into play with different parts of the sales process. All right. So how do you make this work? Well, if you're going to just flat make up some revenue, yes, it's possible to just go in and do a topside transaction, right? Add $1 million to the sales revenue account, add $1 million to the account receivable, but that's pretty obvious. I mean, right, everybody's going to notice, wow, on the last day of the period, you did 2 topside transactions for huge amounts. That sounds like fraud. So they won't do that. They might, and then go back and fix it or something, but related party transactions. So they sell to, maybe they put an account on the book and a customer is really a related party, right? The CFO creates a fake company and they sell stuff to that fake company. Right, that's a related party transaction. Sham sales is just like totally fake, made up, like what Health South did. Just make up a sale. Bill and hold, just like it sounds. We are going to make a sale to you, customer, but we'll hold it for you. All right, we're not going to ship it to you because they're saying, well, we don't need this month. We don't need it. Every month we order, and they'll call up and they'll say something like, hey, we're going to offer you a discount to buy this month. Well, I don't have room in my warehouse. I don't need that stuff. Well, we'll hold it for you, right? Remember, delivering the good or the service is what triggers revenue. So even if they're legitimately going to buy it and you're going to legitimately ship it someday, well, a bill and hold transaction is not revenue in this period. Side agreements. Okay, look, I know you don't want this product. I'm going to ship it to you, and if you end up not using it, you can return it, or you can pay less. Right? I'm gonna put on your bill that you're paying full price, but really I'm going to give you a separate discount. Right? Little separate side things. Consignment sales. So you tell a customer, okay, I'm going to ship this product to you and it'll be on consignment, so you don't have to pay for it. If you sell it, then you pay us. All right? So yes, a product shipped, but it wasn't a sale. right? So that's what a consignment sale is. Somebody else is selling it, but they just have your product. Like when you go in H-E-B or Walmart, the beer, the Cokes, the bread, a lot of those items are actually on consignment. That's why you see the Buttercrust bread guy stocking the bread. That's why you see Budweiser beer guy stocking the beer, because it belongs to Budweiser and they're just stocking it there. And so it's not a sale for H-E-B. I mean, it's not a sale for Budweiser. It's sitting on their H-E-B shelf. So it's not a sale for Budweiser till H-E-B sells it. That's consignment. Channel stuffing. So the people you sell to, if you're a wholesaler and you sell to retailers, they're your distribution channels, right? So channel stuffing is like it sounds. You stuff a lot of product out into your distribution channels, and then they're gonna probably return it, right? Famous case of this is Krispy Kreme. So there's a lot of Krispy Kreme stores out there, and those are franchises. And so Krispy Kreme, the company, says, hey, franchise store, we're going to ship double stuff this month. And like, hey, we don't need double stuff. We can't use it. And they return it, right? So they channel stuffed. Lapping or kiting, that's using money from one account, posting it to another, going forward, so you keep covering yourself. Refreshing transactions. So if you have an account you've made a fake account receivable, or you've channel stuffed or something and they're not paying you, well, that account receivable is going to get stale, old. They're not going to pay. It'll be 90 days past due, 120 days past due. Well, if that's on the books, that's going to look suspicious. So you have to kind of refresh that. Liberal return policies, right? If they return it, it wasn't a sale, right? So they say, oh, I don't want to buy that. And you say, well, that's okay, I'm going to ship it to you anyway. So now it's shipped, so you claim it's revenue. And then you tell them, oh, you can return it any time, a long time from now even. That's fine. But we're gonna ship it to you anyway. Partial shipment, right? So it's not a sale till it's shipped, but you put part of it in there, you invoice them for the whole thing. Who's to say what was in those cartons? Improper cutoff. That word cutoff means it's cut off at the end of the accounting period. So the stuff that's in that period stays in that period. The stuff that goes in the future period goes in the future period, and so they don't get mixed up, right? So that's the cutoff point, right? The year or quarter, month end, whenever you do your financial statements. So if you hold the books open, you're using an improper cutoff, right? So it's like, oh, our quarter ends on the 31st, but let's hold the books open for the first 5 days of the next month, and you're going to catch those sales and that stuff in that previous month. So that's a cutoff problem. Round tripping is basically not a sale. You kind of typically have a side agreement of some kind where it's like, yes, you're selling them a product, but you're giving them the money to pay for it, is basically what a round trip is. All right, so these are very common revenue-related fraud schemes. Revenue is the number one kind of financial statement fraud because it's easy to do, can be pretty easy to hide, and it gets a big effect. It increases your net income. It makes you look good, like you're doing good. So they like to do that. So now that you understand some of the schemes, in our next video, we're going to come and talk about, okay, if people are doing these schemes, what would you see? So we're going to talk about symptoms.